Thank you. Brett really got us thinking about the future, and I want to start maybe by explaining to you that my heart is just fine. I had to check Twitter to make sure nobody tweeted anything out to worry my wife. No heart attacks. We're good. But Brett really looked into the future, and one of the things he talked about was moving at human speed. And yet sometimes that's absolutely necessary because we are humans, after all. So I'm going to put this into a little bit different perspective than what you heard from Brett, what I know you're going to hear from my friend Sam Maul in a few minutes, and perhaps what you'll hear from the rest of the speakers today. I believe I may have the only presentation here today without a picture of a robot in it. We're going to talk a lot more about humans because we're the ones that have to live with this technology. And oh, by the way, our customers are still human too. So even if our robot overlords do take over the company and do all the jobs for us, unless we can find a way for them to sell to other robots, we're going to have to do this at human scale and at human speed. So I'd like to start by talking about success. Some of you here may be celebrating the success that you've had in the past. You may be here today preparing for success in the future. But here's the problem with success. It's a poor teacher. What got us to this point is not necessarily what will get us to the next point. The things that we did, the best practices that we have worked on and promulgated throughout our company may not be what takes us to the next level. In fact, I'm going to bet that they probably are not. Most of my career in the banking industry, and I spent 20 years helping to grow a pretty small bank of about $6 billion of assets to $400 billion of assets. And during that time, my time in the industry looked something like this. For the most part, rising asset prices, falling interest rates, in an era of deregulation. We're now in an era of re-regulation. We're trying to think about all of these things that happened because what happened after that era was 2008. And you all know it as the global financial crisis, and it was the global financial crisis. But there was a lot more going on in this time frame. We look back about 9 or 10 years and think about not only what happened in the industry in the global financial crisis, but think about the technologies that emerged during this time frame. Brett talked about a lot of these. You're going to hear a lot about these today. So during the same time frame, while we got focused about the global financial crisis and how do we prevent that from happening again, I don't think we paid enough attention to what was happening outside the industry and the way these technologies have changed the way we live our lives. Michael Porter has a framework he calls 5 forces, and we could talk about every one of these 5 forces today, about how technology has changed the nature of competition. But I'm going to focus just on one today, and that is the threat of substitution. In other words, it's not about bank versus bank, and this is exactly what Brett talked about, is this competition now is much more asymmetric, and it's coming from the edges of the industry and even outside of the industry. So you can substitute your bank. You can live your financial life today without a conscious relationship with a traditional regulated bank. Sure, they might be the provider behind the scenes of some of the technology, but the nature of that relationship and your deciding, oh, I'm going to be a customer of this bank or that bank, has really changed because we can substitute it for something that's not a bank any longer. And your strategy works until it doesn't. What this says is we're strategically positioned better than just about anybody out there. Never in my wildest dreams would I have aimed this high. they might have wanted to aim just a little bit higher, because this was Blockbuster in 2010. And Sung-Pil Oh just asked this question to Brett King a few moments ago and talked about Blockbuster. It's easy to use them as a punchline of somebody that's no longer relevant, but I think we need to take a step back and think about Blockbuster and what the video industry was like. Sung-Pil talked about this, right? Before Blockbuster, you went into a neighborhood store, and originally this was even before DVDs, right? These were VHS and beta tapes that we loaded into a VCR on top of our giant television that wasn't yet a flat screen. And the local stores could only afford to keep a couple of hundred copies, so the one that you wanted was never there. You came in for your first choice movie, and you walked out with your 10th choice movie. What Blockbuster did was executed that same business model better than anybody else. They put scale against it. They were able to use barcodes to manage their inventory. They had external warehouses so they could shift inventory to different stores so that the movie you did want was more likely to be in stock. There's an old saying in real estate that the number one thing for real estate is location, the second thing is location, and the third thing is location. Well, that was certainly true of Blockbuster. They had location, location, location. They had the best locations in all of the right neighborhoods, and they had scale. And I think this is a fairly decent analogy to think about the banking industry, because that's how we have thought about it too, about having the right branches in the right locations and executing that business model just a little bit better than everybody else. The 1990s and the early 2000s were a period of great consolidations, a lot of mergers happening in the banking industry. And the winners of that era were those who executed that same business model better than anyone else. But success is a poor teacher, because as you already heard from Brett this morning, those aren't the things that are going to take us to the next level. So what is convenience? The survey in 2014 looks like the same survey I have seen just about every year I was in banking. If you ask customers to define convenience, the number one answer, branches near me, location. In 2015, for the first time, it wasn't the number one answer anymore. It wasn't even the number two answer. It was the number three answer. And the number one answer, out of nowhere, suddenly, it was, do you have a leading mobile or online banking capability? So the very way that our consumers are measuring convenience is changing right before our eyes, and sometimes we're the last ones to see it. Now, in the U.S., Brett was actually a little bit modest. He predicted in 2006, he coined a phrase that I like quite a bit that says, banking is no longer somewhere you go, it's something you do. Before the major smartphone for us in the U.S., of course, was the iPhone in 2007. And you look at the growth since then. Of course, you all in Korea laugh at these numbers. You have much higher penetration of smartphones here. We're a little bit behind you in quite a few things in the United States. But to give you an idea of what the last decade or so has looked like, so we should have seen this coming in 2015 when the percentage of transactions taking place on mobile exceeded for the first time the percentage of transactions that took place in the branch. Brett saw this 10 years ago. We should have been thinking about this and preparing for it, and some have, but many have not. So Bank of America, in their fourth quarter earnings last year, disclosed some usage detail about their mobile banking. They're adding between 500,000 and 1 million new monthly active users every single quarter. And the percentage of interactions are growing every single quarter. So we're starting to see it now. And as bankers this is what we need. We need to really be able to see these things. It's hard to just hear about it and think about it conceptually, but when we see data like this, and let me make it even more explicit, the weekly mobile interactions are now 12 times those in the branch. Okay. With apologies to William Gibson, who said this about the future, disruption is already here. It's just not widely distributed yet. This talk of disruption, well, we still have banks, we still have branches, we still have bank accounts, we still have signature cards, we still have the plastic credit cards that Brett said we won't need in the future. I think directionally he is correct, by the way. But how far off is it? Well, it's already here, depending on where you look. I like this quote from Bill Gates that says, "We always overestimate the change that will occur in the next 2 years and underestimate what will occur in the next 10. So the key is to not let yourself be lulled into inaction. If you look at this 10-year period, I suppose part of this depends on when you start counting, but here's a 10-year period from 2001 to 2011, looking at the most valuable companies in the world, and you see energy in there playing a predominant part, a financial service company in there for, well, at least one in each of those 3 years. In 2011, Mark Andreessen, the founder of Netscape internet browser and one of the world's most successful venture capitalists, wrote a piece in the Wall Street Journal saying, software is eating the world. And it may not have looked like it in 2011, but if you look forward not even 10, just 5 years, you can see now that the 5 most valuable companies in the world are all technology companies. So disruption is happening at different levels. A lot of it, what we have seen so far, is at the experience level. Brett kind of talked about this too, the experience layer. So putting a digital wrapper around our existing products and processes, creating an online app or a mobile app or an online application. So there's disruption happening at this level. But I think if we look deeper, we're seeing even more. The next layer in is the tactical level. So this is where APIs and re-engineering the processes that connect that digital front end to our back end, which in many cases in the banking industry is pretty old and antiquated, but we're already seeing disruption starting to happen here, and I think we're going to see a whole lot more. And then a layer deeper than that, the strategic level, and these are some of the things that Brett talked about, things that can actually fundamentally change our business model, things like blockchain, distributed ledger technology, things like artificial intelligence, that not only change the way we do things, they may actually change the business and the business model of how we make money. A useful way to think about this is in terms of time horizons. McKinsey figured this out in the late 90s. And we're pretty good at Horizon 1 in our industry. These are the things that we normally get done in maybe 18 months or less. This is about extending or defending the core business. You can see some of the things at the experience level taking place here. But Horizon 2 are building emerging businesses. Now these can take 18 months or 36 months or sometimes even a little bit longer to happen. And I don't think we've been as good at that, let alone looking out to the third horizon where we create viable options for ourselves. A couple of the questions that I saw come through and some of the questions that Sung Pil asked of Brett about how do we deal with this as bankers in our industry, I think are really important questions. Because it's one thing to say first principles and start with a blank sheet of paper, but if you're a banker today with real live customers and a real live balance sheet, you have to work with what you have. So I do think you have to prepare for the future, but you also have to work on today. You heard Brett say this live here. By 2025, the largest financial institution won't be a bank from a leading developed economy. It'll be a technology company in emerging economies. I agree with that. I don't know if 2025 is the right number or not. It may very well be. That's just 8 years from now. A lot can happen in that time frame. But here's the good news, bankers. You don't necessarily have to be out on the edge, but you do have to close the gap. Because what's happening is our customers are getting more and more used to things like Alipay and Amazon and any number of high technology things. KakaoTalk now has a partnership with Alipay, just announced last month. So our customers are becoming increasingly digitally fluent, and we're kind of holding ourselves back. So you have to close that gap. Why do customers even like fintech? Interesting research done last year by Capgemini and EFMA, and they asked about 800 bankers and about 14,000 consumers worldwide about what were the advantages, and you can see some of the answers on the left-hand side about easy to use and lower fees, and there was kind of agreement. But as we get over to the right, you'll see differing perceptions from the consumers and the banks. So let's look in a little closer here. 79.6, almost 80% of customers said, I really like the experience. It's good service. About half of the bankers thought that might be why customers were liking their fintech. Quick turnaround, faster service, again, 80% and less than half of that for the bankers. So I'm not sure we're keeping up here, folks. I think we have to look at where the market is really going, not just where the technology is going, but where are the customers going? For those of you who like ice hockey, probably the greatest player that ever lived was Wayne Gretzky. And the phrase that was used most often to describe why he was the greatest was said, well, other people skate to where the puck is. He skates to where the puck is going. We have to skate to where the puck is going in our industry too. In this $40 billion that's been invested in fintech companies over the last 3 years, I think is really just the tip of the iceberg. We hear these stories of these two kids in a garage that start a company and it becomes something big. Well, those are very few and very far in between of all of the thousands of companies that are started every year. But think about how those large technology companies, and we've talked about some of those already, are getting engaged in this. Right? Alibaba and Ant Financial is an absolute amazing example to think about this. Facebook and Google in the payments business. Starbucks, the coffee company from Seattle, where I live, has nearly $1.5 billion of deposits right now. They're not trying to be a bank, but they provide such a good service that people are leaving money there. The other thing that I think we're not paying close enough attention to is this digital arms race. If you look at some of the leading banks here, and this is, I'll admit, a US-centric slide. I do most of my work in the United States. But I could probably do a similar chart for just about any developed country in the world. Is they're really looking at acquiring some of these companies or at least investing in them. Incubators, they're building their own and they're partnering, and we're going to talk a lot more about that. Okay, so what do we do? What do we do about this? This fourth revolution, this financial revolution, I call an era of digital disruption. So this disruption that is happening already, driven by digital, I think there are 3 keys to thriving in this era. And the first is to understand that plan your work and work your plan doesn't work anymore. We're used to thinking about putting all of our smartest people in a conference room and thinking really, really hard about our business and the future and what do we think, and we'll plan this all out. And oh, by the way, one of the things we normally do in this process is we make up numbers. We put them into a spreadsheet because we don't know what the future looks like. So we say, yeah, I think that will grow to about $10 billion next year, and we don't know. But we put a lot of faith in this process. And then we kind of fool ourselves into thinking that when we're done with planning, we flip the switch and now we're over here into execution mode. Now we just execute the plan. We planned our work. Now we work our plan. And it doesn't work anymore. The great Prussian military strategist Helmuth von Moltke said no battle plan survives contact with the enemy. I think the boxer Mike Tyson says it even more clearly. Everybody has a plan until they get punched in the face. So what we have to do is move away from this planning methodology to think that we can think about it all ahead of time and put it into this plan that now we must merely execute. And we have to be much more iterative in the process about test and learn, test and learn. Let's test something small, see how it works, learn and go. I know Professor Kim is going to talk about blackjack. I saw his slides in the book there, and whether you prefer blackjack or poker. You would never take all of your chips and put them in and say, deal me some cards. I sure hope they're good ones. No, you would make the smallest bet possible and test, and when you have good cards, you increase your bet, and when you have bad cards, you wait for the next hand. We call this fast, iterative, responsive experiments. My partners and I launched a company last year called the Fintech Forge, and this is our core principle. It makes a nice anagram in English called FIRE, F-I-R-E. And the nature of FIRE is really taking the best of things like Agile and Scrum software development, customer development principles from Lean Startup, and corporate strategies like Six Sigma, and putting them together in a way that works for financial institutions that operate in a highly regulated environment. Bankers, we like Six Sigma. That is getting out as accurate as we can, and that works really well when we have known solutions to known problems. But I think we need to embrace the power of One Sigma, and that means, that looks pretty good. Let's move forward and test it and see what actually happens in the marketplace, instead of thinking again that we can plan it all out and then we'll just measure this later and keep iterating on this. So in a way, this is a different way of looking at what Brett talked about in terms of first principles. It's testing things and seeing how they work. We also have to rethink where technology fits in our business processes. If you think of a hospital, I think it actually has some interesting analogs to what we do in banking. In the pharmacy, in the lower left-hand corner, what's key to be successful in pharmacy is 50 pills at 200 milligrams each, nothing more, nothing less. How quickly and efficiently and accurately can you create those pills? Well, we have some pieces of our business that are like that now. You think about transaction processing, right? And our technology works really well there. If we move up on the chart to nursing, nurses still use very strong, strict protocols, but the hands-on part really matters. And what they call the bedside manner, being higher touch with the patients. In the lower right-hand corner is brain surgery. It's highly technical work, but we don't have to be very good with the patients, because at least if we do it right, they are knocked out. They're asleep during the surgery. And that leaves the upper right-hand corner for psychotherapy. And this is both high touch and highly specialized. That 50 minutes on the couch, really understanding what makes you tick and what are your motivations and what are the pains and all of that. And I think in financial services, that really has been where the human interaction has been the most valuable. right? We do some brain surgery, some highly technical things in capital markets and some very complex lending. We do some nursing, which is maybe some higher touch servicing, or some of our small business SME applications might be like nursing, where we're following a strict protocol, but we're a little more hands-on than we might be with something like an ATM machine. But that psychotherapy, that time on the couch, is really valuable to understand our customers. And this is the part that I think we resist the most of thinking about technology. Because technology, certainly, we get how it works here. Because an ATM machine is actually pretty similar to the pharmacy. Exactly 20 bills of 10,000 won each, nothing more, nothing less. We're good at that. But the way technology has evolved, it's now be able to do both more complex tasks and more personalized tasks. And guess where it's heading next? As these things continue to evolve and merge, we're able to do a better and better job customizing for our customers in a way that's actually very meaningful for them. The second thing we need to do if we want to thrive in this era of digital disruption is we have to be willing to partner. And Brett talked about this. Jamie Dimon, the CEO of one of the largest banks in the world, says, "We are completely comfortable partnering where it makes sense." Now, this is one of the largest, most sophisticated banks in the world, and he doesn't believe that he has to build it all in-house. A couple 100,000 employees, including a lot of engineers, a lot of programmers. They're more than willing to partner. You're going to hear from Sam Maul right after lunch, and I have a quote from him too that I really like. "Just because you can build it yourself doesn't mean that you should." Here's the thing, bankers. Your customers trust you. Despite all of the things that we have done to destroy trust, all the bad things our industry has done, they still trust you. In this World Banking Report survey, 96% of customers said they trust their bank completely or somewhat. What do you think this number is for fintechs? You don't have to say it out loud, but put a number in your head. I'll bet it's a number that's lower than this. So the edge that you have is not as great as you think it is. And your customers actually trust fintechs too. So we need to partner with them. In fact, the same survey asked, would you be willing to refer your bank to friends or family? About half said yes. Almost 2/3 said they would be willing to refer their fintech. So I think this trust factor is higher than you might think it is on technology. And I work a lot with senior leadership teams and boards of banks. And what I hear sometimes is, well, we already partner. We have a couple of tech vendors and we have a procurement department. That's not the same thing as partnering. Asking those two kids in a garage who've developed amazing technology to indemnify your bank, your multi-billion-dollar bank, and to sign an inch worth of financial disclosures. There's moving at the pace of technology, there's moving at human speed, then there's moving at bank speed. And I think we need to speed it up quite a bit. Because bankers are from Mars and fintechs are from Venus. You're on different planets. You don't speak the same language. When these partnerships come together, I hear a lot of talk about the technology. Yes, the technology has to work together. You have to be able to make sure that this new digital technology matches the core systems that you're already running inside your bank. That's necessary, but insufficient. in addition to the technology, we have to make sure that the culture, the cost, and the compliance all work too. And the compliance, I think, is the toughest thing. In Silicon Valley, there's a famous phrase, this came from Mark Zuckerberg and Facebook, where their motto was move fast and break things. I think that's a much more aggressive way of saying test and learn. Test and learn works, but I don't think move fast and break things works in a highly regulated environment where we work. So we have to make sure that the compliance works in our partnerships with the fintech companies. Another survey here asked banks about their fintech partnership, and they said, where do you see the upside? Why would you be interested in partnering? 87% said to cut costs. Well, I agree with that, but I think that's thinking pretty small. Right? Those are back office impacts. How do we take all the things we do today, which we do fairly manually, fairly expensively, and oh, by the way, we duplicate it across the industry because we have thousands and thousands of banks around the world who do pretty much the same things in pretty much the same way. So can we reduce costs? Well, sure we can. And I think that will happen. 83% said, well, we could refresh our branding. We know we feel a little old and stale, and maybe we can put this digital wrapper around what we do today and seem a little bit more modern. And I think that's true too. But I was shocked. I was shocked to learn that barely half had thought about fintech as a way to improve revenues. I don't think we're thinking big enough here. Okay, the third thing that you have to do to survive and thrive in this era of digital disruption is to understand that innovation is an act of leadership. We have a lot of leaders in this room today, and I'm really glad that you are here. I believe that your most important role as a leader is the allocation of resources, financial resources, human resources, managerial time and attention. And innovation doesn't just happen. It's led and it is empowered by leadership. In 1960, Ted Levitt, professor at Harvard Business School, wrote a pretty famous piece called Marketing Myopia. And in it, he argued that the decline of the railroad industry over the prior century, well, the rise, then ultimately the decline, was because the railroads thought of themselves as being in the railroad business. Myopic, right? A very narrow view of thinking they were in the railroad business, where they should have realized they were in the transportation business. Now, I started off talking about the threat of substitution. This is exactly what happened to the railroad industry. Interstate highways and trucking and shipping and air freight and all of these other things became better substitutes for all of the businesses that were conducted by the railroads. And believe it or not, I think the railroads are also a pretty good analogy for the banking business. You think about the high cost of entry. It was very expensive to build a railroad. You had a small number of these protected by tariffs and laws. So it wasn't about controlling the industry anymore to be successful by around the middle of the 20th century. It was too late. It was this threat of substitution that happened all around. So almost 50 years later, some colleagues at the Harvard Business School, Hagel and Singer, came up with a model they called unbundling the corporation. And they said there are three core domains that we have to manage in industry. But we can only pick one to be really, really good at. We have to do all three, but we can only dominate in one. Relationship management, infrastructure management, or product innovation. I don't believe that more than a handful of banks globally will be true product innovators. This is part of why I believe so strongly in partnerships. As Sam says, just because you can doesn't mean you should. Like Brett said, you can bend time and space and do in 5 months and $10 million what would cost you 2 years and $50 million. So I don't believe that the path forward for banks is about being a product leader in and of itself, even though products do matter, and we'll talk about that. So then the choice becomes, are you going to be a better infrastructure manager or really better at relationship management? And most of the leadership teams and the boards that I talk to, when we go through this talk, and they say, well, yes, we are in relationship management. That is our business. That is what we're good at. But if I look at how they spend their money, if I look at the things that they talk about in their annual report, if I look at the minutes of their board meeting and their senior executive meetings, it's not about this highly customer service-oriented, customer comes first mentality. The industry has been cost-focused, stressing standardization, predictability, and efficiency. Remember, that's what grew us in the 1990s and the 2000s. We executed that business model better than everybody else. That's exactly what you would do if you thought that was a strategy to win. But if you buy my argument that that's not what's going to work in the coming decades, well, then I think you have to rethink that and really get closer to the customers. So let's take a look at a business growth curve. And instead of this being a nice, round curve, I think the reality is the middle is much bumpier and much longer than we think about it. Jeffrey Moore calls this the infinitely elastic middle. I think that's right. We have a period of growth, and virtually nothing we're in today, none of the businesses we're in today are in the growth stage. Some are in the decline stage. Most are in that mature stage where we have some ups and downs, but they're much smaller. So if we think about these strategies, this relationship management strategy and this infrastructure management strategy are really about expanding the middle. How long can we continue to do that? Well, we've done it for a long time already, and we may continue to do that. We probably are going to have to figure out some efficiency and renewal strategies for those products that are really on the decline. But if we're going to energize growth again, I think we do have to think about product innovation. Even if we're never going to own that internally, I still think we have to own it in terms of a strategy for being relevant to our customers. So let's look at this a little bit differently. Launch, growth, decline. We just looked at that. We said it's not quite a long curve. What we really want to do is jump the S-curve. We want to be able to, once we get to a part that's slowing down, we want to figure out the next curve that we can jump to. And I love that Brett talked about Apple. A lot of people fail to recognize that in 1997, when Steve Jobs returned to Apple after having been kicked out of the company, they were nothing but an also-ran third-tier computer manufacturer. They had about 3% market share. And what Steve Jobs said to the board and to the employees of Apple at that time is, we're doing too many things and we don't do them well enough, so we're going to cut down. They got out of the printer business, got out of the peripheral business, and they focused on kind of their core offerings. And that was exactly the right strategy at the time. And this is the one that I think we understand in our industry. Yes, that's right. Let's stick to our core competency. Let's not get into some of these things that we don't understand. Let's just focus on gathering deposits, making loans, maybe a little bit of payments around the edges. But that is not the strategy that made Apple the most valuable company in the world and Steve Jobs a legend. Steve Jobs was able to catch not one, not two, but three growth curves. First with digital music, secondly with smartphones, and third with the tablet. Pulling off one of those in your lifetime is heroic. The norm is something much more like Blockbuster or Kodak or Nokia, where the business changes and we just can't keep up. He actually was able to do it 3 times inside a decade. And we're not really wired for this. This is what our business cycle looks like, right? We've had the launch and the growth period. We had an explosion of credit in the 1980s, particularly personal credit, particularly around home equity credit in the US. That blew up big time in 2008. And so we're at this low single-digit kind of growth period. And if we're going to reignite growth, if we're going to catch that next S-curve, we've got to have some strategies that will get us there. And this is where I agree with Brett. The incremental iteration is not enough. You have to do that too. One of the silliest things I think we say about our business is, well, you have to disrupt yourself before someone disrupts you. Well, that's ridiculous. You can't disrupt yourself. You've got customers that are depending on you. You have shareholders that may be depending on you if you're a publicly traded company. You have to keep that going, so those short-term iterative things are necessary, but they're not sufficient. If we're going to catch growth again, we need to be able to jump the S-curve. And what causes that to happen is this innovation word. And that's a word that's really scary to a lot of bank boards and senior leadership teams. Innovation sounds like something that's risky, something that the regulators will hate, something that the shareholders will hate because it's unproven. We have real customers today buying our products, generating real live earnings. Why would we risk any of that for something new and unproven? And that's exactly what is known as the innovator's dilemma. Clayton Christensen wrote a book about this 20 years ago now, in 1997, about the innovator's dilemma. He talked about the steel industry, and I'll give you just a very, very short version of the story, but steel was disrupted by mini mills who could produce steel for 1/10 the cost of a traditional integrated steel manufacturing plant because it cost about $1 billion to build one of those. There's only one catch. They could only make rebar, the cheap crisscross metal bars that's inside the concrete in the floor here. But with a 90% cost advantage, they were able to work themselves up the food chain. And pretty soon they could do rods and bars, and then structural steel and I-beams. And eventually, all that was left was the highest margin part of the business, the flat-rolled steel business. And eventually they figured that out too. You know what happened to the steel industry. Went through a lot of pain and restructuring and bankruptcies. This is the threat of disruption that we have. It's already here. It's just not widely distributed yet. So as we think about innovation, the stuff that's really close to what we're doing today, our existing products and our existing customers, can be thought of as core innovation. And we do have to do that too. We have to keep making it better, these continuous improvement. If we start to get out there a little bit, looking at new markets, new products, it's what we call adjacent innovation. And if we really get out there, completely new markets and or completely new products, that really is where the transformational innovation comes from. So as we move from that lower left quadrant up to the upper right, it's riskier. We have more and more unknowns as we move out there. But it's also higher reward. I can tell you that there was a study done in 2012, a monitor group that looked at this, wanted to know, is there a magic ratio where we should allocate our innovation resources, our time and our money, into these sectors? The short answer is no. Unfortunately, there's not really one magic number. But if you wanted a place to start, you might think about 70% at the core, 20% in the adjacent, and 10% transformational. Companies adjusting for the industry, adjusting for the market dynamics, adjusting for other performance factors for the company, that is a great place to start for total return to shareholders. So taking that risky money on things that you don't know about, only maybe 10% out on the riskiest range. Turns out that's the way Google looks at it, so it's sometimes called the Google ratio. But interestingly enough, if you look at return on innovation, not just total return, look at return on innovation, it turns out the returns are exactly opposite. You get about a 10% return on your core innovation, for which you've spent 70% of your resources. You get a fair trade and adjacent, 20% return for 20% investment. But you get outsized, large rewards. 70% return on that 10% that you've invested in transformational. So I mentioned that I wanted to talk about humans. See, no robots. They're all humans. We have two groups of humans in our organizations. We call them trailblazers and traditionalists. And the traditionalists want to master the known knowns and enforce best practices. Well, that's all about the past. That's all about getting better and better and better and better at the things that we've already been doing all along. Nothing wrong with that, by the way. That's exactly the person I want running the audit committee. That's exactly the person I want managing the risk of my loan book. But I'm not so sure that's the person I want leading my overall strategy. The trailblazers want to explore the unknown and develop next practices. What are going to be tomorrow's best practices? These are the next practices. Because managing innovation is very different than managing the core business. Core business, existing products, existing customers, existing markets, and so on. And innovation about new products, new customers, and so on. Most institutions don't have a full-time chief innovation officer. Some do. This is a new job title we've seen in the last 5 years. Chief innovation officer. Teams full of people. Most organizations have what I call and-Is. That's somebody with and innovation tacked on to their existing job title. And-Is need support. We just talked about managing innovation is different than managing the core business. It's about next practices, not best practices. It's about test and learn. It's about finding out new ways to create value for our customers, for our shareholders, for the organization. But we can't just hire some young people with mohawks and hoodies and think that that enough will do it. We have to give them the support and the infrastructure. Perhaps Peter Drucker said it right many years ago, that management is doing things right, but leadership is doing the right things. So let me leave you with this. You have a couple decisions to make here. You decide, do you buy this argument that I said that we're in this new landscape now? Or do you think that's wrong and the old world order will prevail? Banking will look a lot like it did in the past when we get to the future. Then you have to decide, are you going to do something about it or not? Because you could double down on your existing strategies. You could hope This is a temporary fad that might go away. You could give up and just give way to the fintech innovators and let them go take off the pieces that they're doing, and you could stay focused on the little things. Or you can embrace and engage with partners. So I'll leave you with this thought. The best way to predict the future is to create it. Thank you very much. So if I could have that slide back up, I have one last slide I wanted to share. Thank you. If you're interested in these slides, I know they're printed in the booklet, but I'm happy to give them to you full color, so they're available here for download as well. So thank you. So I think we wanted to take, I think we have a couple minutes left for question and answer. Yes?
네. 저희 앞서 말씀드린 대로 심플로우에서 질문을 한 2개 정도 받았습니다. 시간 관계상. 네, 심플로우 잠시 띄워주시겠습니까? 예. 그리고 강연자분께는 통역기를 좀 부탁드리겠습니다. 네. 통역기 좀 가져다 주시겠습니까? 채널 2번으로. 네. 착용하고 계시는 거죠? 예. 네, 플랫폼을 가진 새로운 비즈니스가 기존 비즈니스와 부딪히는 일이 많아질 텐데요. 결국 기존 기득권 비즈니스와 갈등도 커질 것이고 규제가 못 따라가는 경우도 많아질 것 같은데요. 감독 규제와 새로운 사업자, 기존 사업자 간의 상생은 어떤 모습이어야 할까요? 네, 잘 들리실지 모르겠습니다. 네, 대답을 해주시겠죠? 예.
So the first question is a very good one, and it's about these new players and these new technologies create conflict. How do we deal with that? How do we deal with that internally? How do we deal with that as leaders? There's not an easy short answer, unfortunately. This is exactly why I focus on the human side of this, because it isn't just about the next cool technology. The whole reason you innovate is to create value. Create value for your constituents, for your customers. And if we get caught up in this notion of chasing the technology, that doesn't necessarily lead us to the right place. So I'll go back to my third point about innovation as an act of leadership. I think this leadership requires a lot of courage, and it requires really embracing this conflict head on. And this is exactly why I look at the disruption and the innovation in the 3 concentric circles. You can do some short-term things today around the experience level to keep that gap from getting too big. Because if you ignore it for too long, what happens is all you're doing is playing catch up. And that's where most of the industry is right now. So you have to do some of that, but we also have to start investing in options in our future to be able to do that. And there will be winners and there will be losers in this. So it's a managerial job to kind of manage the pace of that change. You don't want to move too fast and ignore all of your existing customers and all of your existing businesses and revenue streams and just jump blindly into something new. So you got to invest a little bit in there, and that's where I kind of like the Google ratio that we talked about, right? Most of your time on the incremental stuff, but certainly a number greater than 0 on bigger changes. So thank you for that.
네, 다시 한번 심플로우 띄워주시기 바랍니다. 다음 질문 받고 마무리를 하도록 하겠습니다. 네, 2번째 질문인데요. 왜 파트너십을 맺는 것이 더 유리하다고 생각을 하시나요?
Okay, so the second question is, why do I see it as more advantageous for partnerships than doing it in-house? Well, I think we've made a couple of good arguments around that today. Brett started with it's cheaper and faster, and as he says, they can bend time and space. That's a pretty strong argument for me. But I think that the technology, the way that we manage technology to serve our existing business, having all of that infrastructure, which we have to manage, we can't ignore that, it's really hard to run the business versus change the business. And the people inside the organization are deeply invested in running the business the way it currently is. and you really have to have fresh thinking from outside that are looking at these technologies. We talked about earlier already the kinds of education and skills that we need. We don't have enough of those in our banks. The short answer is it's just going to take you too long, and you'll probably build something that is not as good for more money in longer time. And I'll just close with Sam's quote that I like so much: just because you can doesn't mean you should. Thank you.
네, 여기서 마무리하도록 하겠습니다. 다시 한번 연사님께 뜨거운 박수 부탁드립니다. Thank you, sir. 네, 감사합니다. 네.